Good afternoon. We thank you for joining us today, taking your lunch hour to listen to a lighthearted topic of employee tax credits. My name is Jon Sluis with Intrust CPA.
I'm Andrew Nichols with Integrated Payroll.
So what we're talking about is the employee retention credit, in the fact that we see this as being the understated tax credit that's out there. We see this as being big dollars that is being left on the table for many businesses here in northern Michigan and West Michigan, and we want to take a little bit of time here to talk through that. And so with that, we're going to jump right in on the employee retention credit. If you recall, as you look back at your 2020, you were dealing with probably lots of alphabet soup and acronyms of government programs that you've never dealt with in the past. Whether it was the Payroll Protection Program or Medicare reimbursement or Medicare supplemental that were coming through, you were dealing with the probably the EIDL, the employee, the Economic Injury Disaster Loan, lots of different things. But many people have not looked at what's called the Employee Retention Credit. Or if they did, they looked at it early on as a either or between the PPP and the Employee Retention Credit. In most businesses said, well, once I made that determining factor, the Payroll Protection Program, that's all I needed to. Because, interesting, at the time and when I've presented and talked through in this, it was an either or. You had to either choose the Payroll Protection Program or the Employee Retention Credit. And most chose for the Payroll Protection Program because it made more sense given the facts and circumstances. Well, we have this this opportunity during the second stimulus that they came out and they allowed us to do and now. And there's a big change between or and and. And that's where we're seeing this opportunity here is the and, is that many of you probably in your practices chose to do the Payroll Protection Program. And we see here now that you can go back retroactively and potentially get the Employee Retention Credit. And it's big dollars, it's big things. So in general, I'm seeing, and this is just a round figure, anywhere between 30 and 100% of what your payroll protection program was. So if you're, an example here is if you were seeing that your PPP was maybe $50,000, we're seeing these tax credits come anywhere between $15,000 and $50,000. So it's big dollars here. We think that you should take a look at them. And if you hear nothing else for the rest of the presentation, just know that there's that opportunity there, that if you have not looked at the Employee Retention Credit, you should look at it. Whether through your payroll company, through your accountant, through otherwise, go back and look at those, and it's real dollars that are there. Are you seeing this come across your desk quite a bit too? Or?
Yeah, absolutely. Right now, everyone's starting to catch wind. You probably already have heard about it, but getting the Employee Retention Credit retroactively impacts the PPP wages that were used. So everyone's contacting their CPA and their payroll department to see how they can allocate this credit amongst the wages available.
Right. And so we're trying to be proactive here and just give you a heads up on the potential of it. As Andrew just mentioned, you may have heard of this or talked with it. It might be from your accountant, it might from your payroll provider or otherwise that are just asking more reactively of saying, hey, have you thought about this? We wanted to spend a little time and kind of give you some scenarios of what makes sense to look at, what doesn't make sense. So with that, we're going to dive in because this is going to start getting a little bit more in the weeds and a little bit more detailed. And so you might be able to fast forward if you will. But starting off here, what we're going to go through is there's the 2020 Employee Retention Credit and the 2021 Employee Retention Credit. And they're very different from each other. And so we've got two different opportunities. And so if you're getting communications, oftentimes you might be getting a communication on one credit and forgetting about the other one or vice versa. So we'll start out here with the 2020 Employee Retention Credit. What that is it's a 50% tax credit on the first $10,000 of wages that were paid during an allowable period. That's a lot said in a very short period. So let's break that down a little bit. 50% of wages paid on the first 10,000 of wages. So that means the most you can get for this credit is $5,000 per employee. So if you think about that, you have 10 employees, that could be as much as $50,000 that you have as a tax credit. It's big dollars here for just 10 employees. So it is real there. Now, the question is going to come, and note I said allowable period. So that allowable period has different ramifications inside of it. And we're going to determine what is that allowable period. Is it for the year, or is it the quarter, or is it even just a shorter period? And so for the 2020 tax credit, this is the one that we're saying go back and look at, there were two qualifiers there. One was whether or not you tested based on a revenue reduction, and the second is based on a partial or fully shut down. In 2020, the revenue reduction in order to qualify for this credit was a 50% reduction in revenue for a quarter. What that meant is if your revenue would have to decrease by 50% from the prior year. So if we're looking at second quarter 2020 compared to the second quarter 2019, your revenue had to decrease by 50%. If that were the case, you'd qualify for that entire quarter. Alternatively, and what we're seeing most businesses qualify under is not necessarily that revenue reduction, because that's pretty hard to hit, especially the way the pandemic ended up hitting. Things opened back up and dollars started coming in. That doesn't mean you wouldn't. There's a chance that it's there. But we're finding most practices are qualifying either the full or partial shutdown. So in the state of Michigan here, if you were partially shut down from the period of, say, March 26th through, most of you were through June 1st. That's going to qualify. That was when there was the stay-at-home order. So for the period of March 26th through June 1st, any wages that you paid out during that period may qualify as this credit. Now, here's why we say it's so important, and when we're looking at this, is you may have also assumed that you use this PPP dollars. And that's where we're seeing this opportunity to come in and really strategize on, well, do we want to use the wages that are during that period, during that shutdown period, for the PPP forgiveness or for the employee retention credit? Because they can be used. You can use both. You can't use them at the same time. That's the key. You can't double dip on the dollars between the payroll protection program and the employee retention program or credit. But you can do both. You just have to have them in different. And so having to jump in and look at these different wages that were paid and where they qualify, you can really maximize both the forgivable part of the PPP and getting this employee retention credit. As you're looking through, kind of how does your interplay with the 2020 tax credit, when you're looking at a payroll side, are you seeing on the reports that are allocated over for that, or what are you seeing?
Yeah, well, every software out there is still catching up. This is all new, so we're retroactively looking back. Everything was built to deal with the 2020 credits, either or, back then. So our system's got reports for PPP loans, and you probably set yours up for an earlier period than you might want to now. So you're going to want to discuss with your payroll provider and CPA to decide how you may want to or can shift that PP loan coverage period.
And that is key, that you are able to go back and adjust that. So even if you've already, as a practice and as a firm, gone and applied for the forgiveness part, you can retroactively now here go and document why we're doing what we're doing to qualify for both. It takes some documentation to do. You have to be very meticulous in how it happens, but it is possible. And it could be different than what you originally set out for.
Yeah, you might have anticipated being able to use up the employee retention credit too fast in comparison to the PPP loan, but then as the year progressed, more things opened up, more of your employees came back, and your payroll dollars increased significantly for the latter part of the year. So,
what we're practically seeing for most of our medical practices and most of our offices that we're working with is that they assume at first that we're going to use the PPP as soon as we get that loan, and then boom, we're going to just spend it out because that was the easiest. But now what we're finding is we may say, well, no, let's use the employee retention credit for that first phase, for that shutdown period, and then use the PPP for the second portion, maybe the end of the second quarter or the beginning of the third quarter, because again, they came back on the PPP and expanded from the 8-week to the 24-week. So again, a lot of what we're talking about here is a lot of one-time rules, nuanced things that changed and ebbed and flowed so much during the process. And why we're coming to you today, because we are seeing that this is a particular credit, this employee retention credit, that is being forgotten or ignored, and it's big dollars that we're seeing left on the table. I can't express that enough, that if you don't take anything away from this presentation that we're talking through here, is that if you as a practice or as a firm or as an office have not gone and looked at the employee retention credit, you should. So that's both for 2020, as well as I'm going to shift now into 2021. So this is the second year that this credit is allowed. So it came out actually here, it expanded on the second stimulus dollars, and they bumped it up from what was anticipated was for a 50% credit for the first $10,000 of wages paid for the whole year. Now it's up to 70% of wages paid for the first $10,000 per quarter. So it's significantly increased on the dollar amount that we're talking about this. Now, the difficulty we see with it is it's also harder to qualify in 2021 as well. And they know that, right? So this is going to hit potentially fewer businesses because most businesses are back in line and back running. And especially if you did a ramp where you were closed down for a while and now you're more the elective surgeries or others or elective procedures and you've ramped back up. But where this would potentially hit is if we start looking at your fourth quarter 2020 compared to your fourth quarter 2019. And if you saw a dip, and it only has to be a 20% dip now versus the other one was 50%. If you have a 20% decline in revenue from 2020, fourth quarter 2020 compared to fourth quarter 2019, you are automatically qualifying for the first quarter of 2021. So these are some easy tests that you should be looking at. And again, what I'm going to summarize here for the 2021 employee retention credit is it's big dollars if you saw a decline in revenue. And you should be looking at your quarterly decline in revenue or quarterly revenue changes to really see if you have a change there. So, we are seeing fewer businesses qualify for the 2021, but when they do qualify, it is significantly more. And so and the other alternative, and that's that revenue reduction, there is the fully or partially shut down qualifier as well. So there's a lot of interplay that come in here, but that fully or partially shut down is where you may see some, depending on what your practice is as to whether if you're seeing a reduction in ability or in services that you're performing. And if you do see if you were shut down partially here in this 2021 for whatever reason because of requirements of space limitations or otherwise, you could also qualify for that. Again, we're seeing this more in the hospitality industry than we are in other industries, but that is a possibility to qualify for. So I'm going to go a little bit now and break in to give a case study, and one actually the IRS uses, which was a chiropractic office. And so this gets into, we've talked about not only revenue reductions, but we're calling partial or full shutdowns. And so the highlight here on the case study would be, let's say, during the shutdown back in March, before in January and February, you were running, you were seeing patients, and you were in person, people were coming in the door, you're great. March comes along and it shuts down and you just go home, everyone goes home. That period you're fully shut down. But then you might start coming back a little bit, or maybe some of the doctors stayed home but started performing services remotely via a remote session. Those are going to be what's getting into the partial shutdown, where you may have some back in the office but some working from home. That's that partially, and then working all the way into the full-time back at the office. So there's a good example of what we're seeing, where it has that complexity of the potential of qualifying or not qualifying.
So, John, one of the questions that I'm getting from our payroll clients is what is going to qualify them for the 2021 credit in the first quarter versus the second quarter?
Yeah. So to answer that, again, I'm going to highlight here there is a difference between the 2020 credit and the 2021 credit. So the 2020 is a full year. That's where we're talking about going back, adjusting. Hindsight is a wonderful thing now. It's the and versus the or. But for 2021, that is a new one that we're dealing with right now. It's still 2021. We still can work on through this. But so what you're asking here is, how do you qualify? Well, one of the things the IRS realized through this process is it sounds great in theory to be able to do this for the whole year, but then there's the practical side of this that says, hey, we have to issue payroll every week or every other week. And so how do we know whether we're going to qualify for the employee retention credit based on a revenue reduction at the end of the quarter when we had to pay payroll during the quarter? So they came up with what was a safe harbor. And so we're able to look at the quarter before to determine the following quarter. So the 2021 employee retention credit is a quarter by quarter qualifier. So you've got first quarter, you've got second quarter. There's a chance that we're even going to expand it to the third and fourth. We'll yet to see that. But in order to qualify, you can look at your fourth quarter 2020 to look at your first quarter. So that way, if you have a revenue reduction of greater than 20% in the fourth quarter of 2020 compared to the fourth quarter of 2019, all of your wages paid during first quarter 2021 are going to qualify.
Okay.
The same can be said. So if you qualify for the first quarter in 2021, second quarter 2020 is going to qualify, or 2021 is going to qualify. It gets a little bit confusing here. Here's where I would tell you as you look through this, the tests can be done in advance now. And so we can be looking at it now for last quarter versus this quarter. So it's a quick revenue test. Talk to your accountant, ask them about that. Give us a call if you have a question with it. But it really, they came up with that safe harbor to determine. You can always go back retroactively. So if we don't meet the safe harbor, and we're paying and we determine we don't qualify in first quarter and all of a sudden there's a revenue dip and we find that out later, you can go back and amend just like we're having to do for 2020, but they're trying to avoid that now. So
that's an important distinction to know, that you don't have to rush, but it's important to look into this. You'll always be able to go back and amend these 941 payroll filings and add in the employee retention credit once you determine whether you qualify.
Question I get quite a bit is, well, you talk about amending here. Isn't that a scary thing? Can we really amend these returns? I mean, are you seeing?
Yeah, it's not as scary as you think. It got a little more scary now that they've added so many boxes and new lines into the form itself. That's what prolonged a lot of these credits, getting back to companies in the beginning of 2020 anyway. We had to wait for the IRS to change the form itself, and they keep modifying it. So you'll want to review this with your CPA. Your payroll provider can help you allocate the wages. You might also be juggling other items on there like the FFCRA, the Emergency Sick and Family Leave Credit. So you can't use wages for the same, or you can't take credit for the same wages here. So it's important that you've talked this through and detailed that out on the 941.
How I'm looking at it is the IRS is anticipating these to be amended. I mean, they didn't come out and say that, but we're telling people you don't have to necessarily worry. Whereas several, in the past, if you had to do an amended return, it was kind of a scary thing. You're basically raising your hand and saying, look at me. That mentality has changed, especially as it relates to the 941s and these payroll taxes. They almost expect them to be amended because if you recall, this second stimulus dollars round didn't come out until 2021. I mean, it was passed in January, and so they're going back retroactively, and they're creating this form after the payroll was done, and so they're telling you to report things on a modified payroll report that wasn't even in play in the first period, and so they know and are anticipating that there are going to be amendments out there. So don't be afraid if you look at this process. Now, you need to know the numbers of where you're putting it, and you brought up a good point on all the different credits and how they all interplay, and the boxes changed. So you got to know what you're doing, how you do it, and where you do it, but don't necessarily be afraid with that either.
Yeah.
We're not spending a lot of time going into the details. We're purposely not trying to do that. There are a lot of nuance inside of that, so it gets into whether you have more than 100 employees or less than 100 employees. There's a difference in wages between Medicare and Social Security and federal taxable and the actual wages that qualify. So we're not trying to use this presentation here to go into all of those details, other than to hear, and as I kind of slowly wrap up, what we're trying to get to you and to understand is if you have not gone for the employee retention credit, if you've not looked at it, you should be looking at it. You should be talking to your accountant or to your payroll provider or someone that you trust on the financial side to be thinking about that. And you can be talking with your other office managers or others that are out there. So, any advice that you give us on, practically speaking, how you're going to apply for these or what you're going to do for them?
Yeah, in order to receive these credit dollars back, it's really going to be driven through the payroll 941 returns. You'll have to amend those filings for the quarter in which you determine you're qualified for, and you want to use those wages towards the employee retention credit.
Yeah. So there a little bit of a history of it. So this program was designed as a stimulus program, or not a stimulus program, but rather as a a program that was trying to get dollars out as quickly as possible. It has since changed more into the stimulus side of things, but it was meant to get dollars out quickly. And so because of the pandemic, they were trying to allocate how dollars got out there. So some of it went through Medicare, some of it went through the USDA for the farmers, some of it went through the SBA, which is what the PPP program was. This particular one, they were using the Treasury to go through payroll. So they divvied up the dollars to kind of hit different programs. The revolutionary change here was that they changed it from an or and went into an and allowed us, both of us. So whereas the PPP was the SBA, this program is actually through the Treasury, which is the mechanism they're using is the 941s. So that's where when the documentation comes and the push comes to shove on this one, it's actually amending and adjusting the 941s that were presented.